Is the median Shopify brand distressed? Do holdcos and e-commerce even work? What's going on with tariffs? And is this 8-figure holdco using AI? Welcome to In the Money, an exploration of whether you can still make money in D2C and CPG. We follow the flow of money between founders, investors, lenders, and everyone else in the ecosystem to ultimately answer the question, is D2C and CPG still a good business? Today we have Kelcey Lehrich on the show. He's an entrepreneur based out of Cleveland, Ohio, one of the original e-commerce platform roll-ups. They're a high 8-figure and near 9-figure holding company, largely vertically integrated and specializing in D2C brands. We talk about big wins for the past year, things he's excited about, tech, tactic and channels, and new product ideas. Hope you'll enjoy the show. Kelcey, no warm-ups here. We're going to just dive straight into the hard stuff. Is your next prospective hire at 365 competing against AI?
Competing, no, but they need to be proficient at using it and using it to do their job better. Today I had a meeting, and after the meeting, one of our team members came up to me with his phone, and he had one of those like phone wallets. And out of his wallet, he slid out this card. It looked like an RFID card or a thick credit card. And it was actually a smart device that was recording everything and would connect to his computer. I don't know if it was Wi-Fi or how it connected. And it was a recording medallion that was going to have an AI transcript of everything. And I said, cool. Wish I would have known that before the meeting, now that I know that everything is on the record. I think AI is great. I can have streaks where I am a bit of a techno-pessimist. I think the recent stuff, we're recording this middle of April, early April, late March, was like the big, hey, AI advertising images are really good. I thought ChatGPT was cool a year ago. This is the first thing where I really stood up and went, wow, like the world has changed. So are they competing? No, they really better leverage it. I think that the competition from employee to employee of who can be productive based on leveraging great tools is there. I don't know that we have Gen AI necessarily just yet competing for jobs.
Is it something that you're pushing down and saying, hey, we're going to be talking about this each week? Are you letting it bubble up?
I'm not driving it. I think the team is leveraging it a good bit. My business partner, Justin, has certain goals around it for himself. I don't know that we have organizationally mandated it, but we have a pretty growth-oriented culture. And there's a lot of high performers on the team that just naturally are curious about it and are leveraging it. So I don't know that we've needed to push it. I'm not super in depth in the like ops and customer service side of the house, but like we use a CS platform that tries to bring some of those things to the forefront. That's a few hops away from my day-to-day purview. They're using it there. Aside from that, I think the team is largely bringing it to their jobs themselves.
So 365, Holdco, focused on consumer products. I think still, correct me if I'm wrong, a specialty in kind of food, consumer goods, some baby. There are a good number of holdcos out there, a lot more a couple of years ago. What makes 365 different?
There is a couple of different categories of grouping together consumer products businesses. I would put us in the pure play holdco category. I think we always had been. Might have gotten a little distracted for a minute with the other end of the spectrum. The other end of the spectrum being maybe the aggregator moniker. So I remember when, I think it was 101 Commerce was the first venture capital-backed e-commerce business acquirer. And they were about 101 Amazon FBA sellers. I said, that seems like kind of weird. And then months and years go by, I'm there, Thrasio and Perch and whoever else, all these big names that have raised venture capital dollars to generate venture capital-sized outcomes, primarily through aggregating small and mid-sized consumer products businesses. Many of them bought business assets that were of dubious quality at best. But there was a idea of we're going to buy it 3 to 4 times and eventually scale to be worth 8, 10, 12 times, whatever it is, maybe more. It's really a venture predicated outcome. We're on the other end of the spectrum of building a portfolio of businesses that are going to have staying power. They're going to have a brand that is around longer than just the latest trend on Amazon or Google. And we're really looking for like long-term durable cash flow out of the businesses. Is, in hindsight, consumer products the best place to build a durable cash flow holdco? I don't know. I mean, the guys rolling up HVAC companies, certainly I'm envious of from time to time. I think every business is hard and has its challenges. So we've chosen to play in the e-commerce land. We'll continue to do so. I've really just decided that the quality of the business is probably the most important thing. So again, we're recording this mid-April. Everybody's talking about tariffs. So like supply chain resilience, pricing power, the actual presence of a brand, not just like I slapped a label on it, but like truly a brand. There's brand search actually happening. Those are all things I think are qualities of a better quality asset, better business. And so as a holding company, we want to just own and operate great quality assets and as many of them as possible for as long as possible.
Why do we love Numeral? Well, here's the good, the bad, the ugly. The good is that over 1,000 e-commerce store owners just like you use them for sales tax compliance, including some pretty big brands like Ridge, Emmy, Nomad, and Graza. The bad is that none of us got into this to spend a ton of time on sales tax and admin, which is why Numeral is able to help you in 5 minutes or less get full coverage, deal with registrations, ongoing filings, and compliance. It just happens in the background. And the ugly is that not a lot of store owners know that sales tax is actually personally guaranteed. Said another way, that the states could end up coming after you personally if you're not on top of it. Even a modest $5 million store owner could have Nexus in 20 or 30 states. Again, Numeral helps you stay compliant, and they even guarantee their work. That's why we love them. Go and check them out at numeralhq.com. Aggregator model, now 5 years into it, certainly has seemed to be a bad bet. I think that's fair to say. Around $10 billion of capital has gone into it, and I don't know what fraction of that will get returned. I think one of the big things, in addition to the quality or lack thereof of these assets, is there were a lot of synergies that were underwritten. Either front of the house and customer list overlap or marketing efficiencies, but probably even more so back of the house, fulfillment, finance and ops, customer service. And I don't know, I've probably spoken to maybe 24, whether you want to call it aggregator or holdco.
Sure.
And almost everyone has said whatever synergies that we underwrote did not end up materializing. Not even not 50%, but probably 1/10 of underwritten synergies. And frankly, that was probably our experience as well. And didn't get much kind of front of the house or back of the house synergy. So I'm curious, you guys have had probably the most impressive staying power of any of the platforms. Do you still underwrite synergies when you guys buy businesses across the current portco, or is it more, no, everything stands on its own and we're just buying quality businesses that send money up?
Great question. My answer to this has evolved but not changed. I probably figured out 3 or 4 years ago that for every synergy we did find, there was at least one offsetting synergy, and we netted to zero. We were fanatical at first about trying the front of house synergies, the cross marketing, the email drop-in cards, the email list stuff. Never did it work. Terrible idea in hindsight. I don't know why I thought that brand A customers would want brand B's products, but we tried it all. On the back of the house side, I don't think we have synergies as much as we now have really good institutional knowledge. We know how to make better decisions. And so I don't underwrite synergies like, hey, your pick pack cost is 3 and mine is 2, so we're going to add back $1 for every shipment. I can see that from the outside and decide that they're overpaying for something. We can look with a more discerning eye at go-to-market strategies, Facebook account structures, supply chain costs. I think we just have accumulated advantage of operators having seen a lot of stuff. So different than synergies, but experience probably is more important to us. To really answer your question, we're building the businesses as individual businesses that could be transacted one day by themselves with no shared services model. To get there, do we still fractionalize part of the accounting team or part of customer service? To a degree, but we're really trying to get the businesses to stand on their own and to be a platform unto themselves, because no, I don't think synergies really work at scale for subscale consumer products businesses.
I recently was pondering this idea that some of our mutual friends all started with a platform of companies. To throw some names into there, Bill D'Alessandro from Natural Dog Co., Taylor Holiday from Common Thread Collective, Sean Frank originally had the agency, Tony Yu from Vessi originally had an agency. And so everyone kind of started with some assortment of between 5 to 10. And now fast forward 5 years later, they're all doing one because one of them had escape velocity. I'm curious what your thoughts about that, and have you seen any power law in your own portfolio?
We've seen some, not as much as some others. People ask me all the time, hey, they write off that list. When are you going to pick your big winner and just make it go to 9 figures? And I'm like, as soon as I find that one, I will pick that winner and I will drag it to 9 figures. That sounds great. Maybe it's a certain amount of luck. Maybe it's skill. There is power law for sure. And you do want to invest in your winners. We've absolutely seen that in the portfolio. I think the list you rattle off is just people seeing that outcome to varying degrees. And certainly, power law is very, very real in the portfolio. That said, we probably have a pretty thick middle of the road section of the distribution where they're great assets. And again, back to the comment earlier of like HoldCo, cash flow, independent businesses. I don't have any outside equity that's going to force me to transact these businesses. I don't have a motivation right now to need to do that. So we're going to hold on to them because they're good assets.
Yeah. You already mentioned earlier, Kelcey, that we're recording in mid-April. We've experienced kind of 2 weeks of tariff whiplash, with folks making products in China kind of really screwed, and everyone else.
Unless it's a cell phone. All of our products are cell phones now, so we're good.
That's right. Yeah. Or we're actually making laptops, and everyone else waiting to see what happens in the next 90 days. How's 365 thinking about kind of tariff exposure?
Changes day to day. So ask me again tomorrow. We can re-record this and I'll get you a new answer. I'm trying to think about the things that aren't going to change. So what are the places in the business that we know for sure are good bets? So it does seem there's a macro policy in the U.S. with China in particular. So any place and every place we can isolate Chinese exposure and still focus on anything. I understand that the news on Vietnam has changed 5 times or whatever it is. I don't know if it's going to change again. I do think it's a better bet to be someplace that's not China than someplace that is China for sourcing. Likewise, we're looking at this as a strategic competition opportunity that in certain product lines, there might be other competitors that are not as well versed in lean operations, that may be a smaller, weaker player in the marketplace. It's an even playing field. They're going to have the same pressures on their costs that we're going to have on our costs. There's going to be advertisers leaving the auction and CPMs will come down in certain markets. So a lot of things I can't control. We're going to work on the ones that we can. We're going to do it as quickly as possible, make great decisions focused on cash conversion cycle, still delivering a good product to our customer. And in as much as we can source things that aren't Chinese in their country of origin, we're going to work to do that. It's not an overnight process and everybody's in the same boat because a lot of these things are clustered in certain manufacturing sectors. So we're certainly doing efforts to diversify globally and taking it one day at a time, to be honest.
In now approximately 5 years of doing this across kind of a dozen or so sample set, we've resourced maybe a couple of times.
It's not easy.
I don't think it's gone well, and so we really don't like doing it. I think as a model, 365 is willing to get more operationally involved. I think from memory, you guys have centralized fulfillment, and you might even do some kind of light finishing or knitting. Yet resourcing, moving out of China, like just talk to me about the back end of the supply chain.
Yeah. Our food businesses and our CPG businesses are heavily US-based supply chains, so more insulated. The food businesses are pretty vertical. We actually operate a good chunk of one of the businesses and basically 90% of the other. So we're pretty insulated there. We have some raw materials like glass was recently an issue. We had to figure out how to source that domestically for a kitting component. The part of the assembly, the bill of materials is a jar, and we buy a lot of these jars overseas. But those businesses pretty easy. Our businesses that have a Chinese supply chain, you're right, it is hard to find other jurisdictions where products are made. And I go back to my comment of like, it's everybody in the same boat. So if you're in, I'm just going to pick a category that we're not in. If you're in socks, they only make socks in so many places. And so there are places other than China to source socks, and that you can probably count it on one hand. And there's that many sock factories in that many countries. There's other products where like they only make them in China, and everybody who makes that, all the know-how, all the tooling, all the labor, all the raw materials that go into those components are also sourced in that same little area of China. It's just going to be a more expensive category for the U.S. consumer for as long as the administration burdens that category. That category's TAM might just go down 20, 40, 60, 80% for the next period of time. And you need to make a capital allocation decision of, can your business survive that? What size will it be? What will your competitors do? And make a smart decision there. The more discretionary the product, the harder that is. So I don't have a magic bullet by any means, but we're looking at all the categories that could leave the country and where can we send them to. And for the ones that are kind of stuck there, we're working on just being as lean as possible in our cost structure, maximizing cash conversion cycle. So looking at like overseas fulfillment, that way we're paying duties as things land. Looking at bonded warehouses on the state side, like anything that can move cash to out into the future. What I don't want to do is pay a tariff bill this month, and then in 2 months the tariffs are different, and my COGS on a whole pallet of inventory or a whole container of inventory are way higher than they need to be. So just trying to be as lean as possible and let the dust settle.
Yeah. As great as resale is and potentially helpful in this new tariff regime, I have a feeling that resale of old socks is not going to make up for the loss in new sock TAM. Today, I want to tell you about More Staffing, a group that we use to help us hire top-tier talent from the Philippines. Now, V1 of offshoring was hiring VAs, doing basic data entry work or administrative tasks. V2 is much more upskilled labor, folks that have been experienced for several years, up to 15 years, doing highly technical things, creative things, or in our case, hiring for supply chain managers and product development folks in the same time zone out of the Philippines as our manufacturers who are in China and Vietnam. More Staffing has deep expertise placing supply chain managers who have worked with Western brands, including many CPG and D2C startups, help run supply chain end to end. We love working with them. We've had several folks placed by them. Morestaffing.co, go and check it out. You already alluded to, this will probably create a lot more special situations, either direct competitors or kind of net new potential categories. It's an area that we both focus on. Sometimes I wonder, why are we such sickos that we like special situations so much? And maybe I'll let you try to answer that first.
That's a great question. They're a lot of fun for those of us that are on the acquiring side of special situations. It's always a tough situation, so I try to approach those with empathy, because usually the founder or president or operator of that brand is having a bad week if you or I are talking to them about a workout solution. So I don't envy that. We've had our own challenges with our balance sheet and various history that we've had here. So I've been on both sides of trouble and lived through it and had the sleepless nights and had the lender calls and all the problems. I think I like it because it is an opportunity to save a business in a lot of cases. And it's some of the most interesting negotiating and game theory of trying to solve a problem. You got this Rubik's Cube of all these problems you want to solve, and there's limited resources. And frankly, it just suits my personality style well for that type of deal making. And it's something I enjoy doing. And it's a niche, and it's you or I or somebody in our position gets a lot of experience. You learn all the tricks, you learn all the pitfalls, and they're unique deals, and they can be very, very rewarding financially and very, very rewarding from just an entrepreneurial value creation perspective of saving customers, saving products, saving brands, saving jobs. And it's really, 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 really good work.
Is 365, would you say that you're focused on special situations as a buyer, or are you still looking at kind of, hey, we'll do the market, does 1 to 3 in EBIT and sells for 3 to 4 times?
We will look at things at market rates. However, our bar has probably gotten pretty high on what it would take to clear a bid from us. And so willing to, but I think we'll find better values, frankly, as a buyer and operator of a special situations brand. So those are very much welcomed. I continue to look at on-market things. I frankly haven't chased one in any material way in probably 2 or 3 years now. So yeah, it's both, but leaning more towards special situations.
So my hot take is that I think the median e-commerce seller is in a special situation. and they may or may not realize it. Um, that I think that there are way more e-commerce sellers that are out of the money than in the money. And again, more than probably that they realize. Um, and I think that's just it's a function of two things. One, which is average debt on the median Shopify business. So let's call that between a $3 to $10 million Shopify seller.
Yep.
Um, the amount of debt has increased over the last 5 years due to both increase in availability of credit, but also just challenges, everything downstream of COVID, supply chain, now tariffs, iOS 14, et cetera, et cetera, et cetera. And everyone's just been grinding. Um, and then the second, which is any semblance of strategics down market has completely evaporated over the last 5 years. And so we're just now back to financial multiples, which are tough. And so the combination of higher debt load and lower valuation range, I truly believe that the average Shopify seller is in a special situation.
I think you're right. I was going to make the joke that you or I no longer need to correct people that the multiple is on earnings, not on revenue, because that expectation of 3 to 6 times revenue is thankfully gone. I say thankfully, not because I don't want people to win. I do, but like there was a lingering expectation of these absurdly high multiples that were not grounded in financial reality.
I think
because of one or two headlines.
I think we both have businesses that are available for sale at 3 to 6x revenue.
You know what? We'll go for 2 times revenue. Two times revenue is plenty. I'll give you a good deal.
Yeah.
I think you're right. I think that there is a lot of debt on balance sheets and a lot of also maybe unbooked liabilities, whether that's unshipped customer orders, loyalty programs, sales tax, just different challenges with floating a business. And yeah, it's gotten to be a more challenging environment. And as the tide goes out, we'll see who's swimming naked, to be honest.
So you've seen a lot of these. What would be your advice to it? Let's say it's not super distressed yet, but it's just challenged. Maybe it's a year ahead of the really distressed. Again, median Shopify seller, even in a top decile one. So let's call it in the 5 to 10, maybe even 15 range. But it's been flat third year in a row. It's still break even plus or minus. It's not over levered, but it has debt. So call it 10% of revenue, maybe a touch more. Its AP isn't impaired yet, but it's starting to play the cash flow roulette, and they're coming to you and saying, "Hey, Kelcey, like business is tough. What are my outs here?"
Yeah, I certainly don't envy that conversation on their end, but I do have this frequently, as I know you do as well. My first conversation is about expectations, and my second is about founder liability and founder risk. So expectations, like, hey, like here's where the market range might be for an asset like yours, and if your expectations back to the revenue multiple joke are like wildly off that, like I would go talk to 10 people tomorrow so that I'm not BSing you. Go call Fan, go call some brokers, like talk to some people to get a real rational, sober look at this. Like you're not doing yourself a favor by having a wildly wrong expectation. And if you think I'm BSing you, like just go double check me, because you owe it to yourself to just be sober-minded and realistic about what to expect. So that's kind of box number one. Box number two is, what's your personal liability? If there's a downside risk here, do you know what you're on the hook for? Whether that be sales tax, wages, things you've guaranteed, like a credit card. A lot of founders that are used to like raising money may not realize what their liability could be in a wind down situation or a sales situation. And again, do your diligence to know what you are and are not on the hook for, and what the reality is of how to see yourself to a soft landing. If the business needs one, you want one for yourself as well. Those are the first two things I talk about with people, just to like set the table for what those options might be. Those options could be a lot of things. sales, investment, lender foreclosure. There's lots of ways to go figure out what to do with the business. Even winding it down sometimes can be a really good outcome from a net cash perspective to the right balance sheet. May not be what they want to do, but it might be a way to get cash out of the company. But before we can go solve those problems of like how to transact the business or how to get them out of it, we need a sober valuation and a sober look at their liability and transaction.
Yeah, I think that that's absolutely spot on. And to put a finer view on it, I think for that kind of $10 million business that's break even, there's kind of three levels to it. One, which is like you're probably in today's market north of 50 and then have some kind of heat. And whether that heat is growth, whether that heat is category like pet or beauty, whether that is hey, there's a really clear path to 200, but it's scaled and has something sexy about it. And then you might be in the like strategic revenue multiple range, and it's probably got some, a profitability profile to it that maps to a very high end of EBIT range, but you can map it to some revenue multiple as well. And that's the spot that everyone wants to be in. And that number seems like it keeps on going up. It used to be maybe start those conversations at 20. Today it's probably 50 to 100. The second is, okay, you're a low mid-market brand and somewhere between the 1 to 5 EBIT range, and you're in the 3 to 6 times. And then the third is everyone else, which is most people, which is, hey, there isn't real EBIT here. And then you're really just trading on an asset base, which is probably just inventory. And so for that $10 million business that's been break even for the last couple of years, that's flat. Unfortunately, it's really inventory value. And I actually think that most people still don't really know that.
I would agree with a lot of that. The only thing I would add to that is there could be a play that is something that you or I or another buyer might look to do in one of those transactions that I think founders, if they're willing to take the pain, could do themselves. And that is oftentimes that $10 million flat business would be a really profitable $4 million revenue business. But the ego hit necessary to do that and to lay off half the team and to cut 3 product lines and to do all the painful things to get down to a profitable, lean company, they probably have stretched past the TAM that allows their brand and product to generate profit, and it no longer generates return on capital. We now need to shrink the TAM to the profitable niche where we can acquire customers more profitably and wring cash out of that business. Probably a smaller company. That's a painful thing to do.
Yeah. A couple of our HoldCo peers have focused on a specific strategy of buying e-commerce and expanding into retail. I think retail has also just gotten a lot more focus for brand founders since iOS 14 a couple of years ago, and probably even more so today. We're maybe at peak retail with the food and bev acquisitions of the last year. Does 365 do much kind of retail wholesale?
If a brand has it, we're certainly going to continue it. Frankly, to be very honest, I think we've struggled with that for quite some time. Every time we've tried to invest in it, I can honestly say we've not succeeded in incredible amounts of growth. One of the challenges I feel like is that every little sector of retail is different, and it's very hard to build a muscle. The skill set you need to sell to Walmart and Target when you're a darling is very different than if you're in boutiques and you're scaling up on a wholesale platform. Is very different than if you're an upcoming food and bev brand that's trying to get into a demo at Whole Foods and then other natural grocers. So we've just found it to be a challenging corner of our business. I love it. I think it's great. Most of the margins that we have in wholesale are pretty good. The problem is the expertise needed and the salary load to get somebody to drive that business forward. I think the diversifier is awesome. Love to see it. If somebody's listening to this and is like God's gift to wholesale, like DM me, email me. It's never been an easy part of our growth story. And I think it's important, but it's not something we've cracked the code on by any means.
For a fun little segue, Kelcey is, you can't tell under that plaid shirt, but incredibly, incredibly fit. In fact, the first time we met in person, I was a little bit shocked at how broad you were.
You're too kind.
You're a CrossFitter. You've competed in CrossFit Open. I'm curious, like, is there a product trend you're excited about for the listeners that are interested in new product ideas? We're at maybe peak health and wellness. Yeah, what are you thinking about for your own world?
In the last 90 days, we've put in a sauna and a cold plunge. So big fan of the contrast therapy for sure. My wife jokes about the various gadgets that I have. There's quite a lot of them in our house when it comes to health and wellness. So yeah, I'm a fan of those expenses to better yourself and to invest in the only one place you have to live your whole life, which is your body. I don't know that I'm the best trend predictor, but I tend to be a somewhat early adopter, and I do think there's only so many houses that can buy a cold plunge or a sauna, but I still think there's many, many more to be sold, and it's gonna be a growing trend for sure.
Yeah, that's so interesting. So you still think that we're early on hot and cold therapy? Because I'm worried that we're maybe a little bit faddish.
I don't know. What I would not want to do is buy one of those brick and mortar spa experiences that just sells space in hot and cold. I don't know what the multiple is to buy a sauna or cold plunge company, and whether or not I would buy the pro forma that the banker would want to sell me for the price they want to pay. I don't think it's late. Let's put it that way. I don't think the market's shrinking. I think there'll be consolidation. I think it's probably a very, very hard market to compete in. There's plenty of brands and plenty of capital chasing it. But I think there's going to be plenty more households with them. The penetration is not yet there, and it is very, very trendy. And anybody who tries it tends to get hooked, and there'll be many, many more sold.
Yeah. We've actually looked at a couple, to your point of that there are so many brands out there. Now, I'm not an expert in it. You're much closer to it. For the, I don't know, 20, 30 more cold plunge sauna companies, like is how does this space end up playing out in the next 3 to 5 years?
I would be, if I was in the driver's seat of one of those businesses, looking at what my competitive environment looks like and doing like some classic business school, like SWOT, competitive analysis kind of stuff. I went down this rabbit hole deep a few years ago and found this concept from McKinsey called the Rule of Three. It kind of defines what the market size of most mature markets look like. And you tend to get three really big players that dominate a certain percentage of the industry, and it kind of trails off from there. I would get a really good sense of where I was competitively if there was any reason why I had a growth track that would change that competitive position. Maybe it's proprietary product, sourcing, a go-to-market strategy. We're made in the USA, nobody else is. There's tariffs. Like, I don't know what the angle is for each business, but if I didn't have a reason to believe I could materially change my position in line, I would try to rationalize the growth rate and the P&L of that business to be at steady state in market share and just ride the growth of the market. I think there's plenty of competition, plenty of venture dollars. I personally don't like to chase competing with those things. And I would just try to lock in a market share and an angle and have a set of USPs that would try to differentiate why my slice of the market doesn't shrink. And I would just ride the growth of that market. As the pie gets bigger, my slice would get bigger.
Yeah. No, I think that's a great perspective. What I want to do today is tell you about Parker credit cards. Look, there are multiple subreddits dedicated to credit cards, points hacking, and cashback, and I get that. But what do entrepreneurs really want in today's market? Help managing their payback windows when acquisition starts ramping. With Parker credit cards, you get up to 90-day repayments on ad spend, so helping you on your cash conversion rather than having all that upfront ad spend before revenue starts coming in. Parker allows you to spend aggressively while still managing cash flow, including meta spend. So instead of hunting for best points or cashback programs, we've now realized the best ROI is to be able to increase our ad spend without hurting cash flow. Go and check them out, Parker Credit Cards at getparker.com. Parker is a financial technology company, not a bank. Banking services provided by Piedmont Bank, member FDIC. Funds in your account are FDIC insured up to $250,000 per depositor for each account ownership. As we round to a close, Kelcey, trying to provide some extra value to the listeners, what has got you most excited for 2025? It could be a piece of tech, a tactic that you guys are pursuing, a channel, a product line. What's got you most excited for 2025?
I'm going to give you the answer nobody wants, which is tariffs, because I do think that the better operators will end this disruptive period of time advantaged. If you are scrappy, smart, resourceful, aggressive, you can make it through a tough period in business. This is not the first one. It won't be the last one. We all have headwinds, and we're all dealing with the same set of challenges. There will be plenty of folks that throw in the towel, get caught sideways, markets will shift, and those who are willing to really operate and execute at a high level, I think will come out stronger. COVID left brands many, many times much stronger than they entered it, and we all thought the world was ending for like 30 days or 90 days. So I don't know what will come out of this, but I do think the survivors will have a really, really strong business model in a lot of ways. And so I'm excited to be on the other side of this and to see what we can do with some of our businesses in a different operating environment.
Kelcey, this is so great. Where can people follow you, find you to learn more? And is there anything that you're seeking from the universe?
I'm on Twitter, pretty easy to find if you can spell my name. My email address is also guessable, first name at 365. If anybody wants to review a deal, happy to chat. Just kind of founder to founder. No hard sales pitch. If you talk to Fan, give me a call too. We send stuff back and forth frequently anyways, as it is. But always looking for transactions and opportunities to help folks. If you're not sure what to do, reach out. Happy to chat.
Awesome. Kelcey, thank you so much and look forward to next time.
Appreciate it.
I love recording with Kelcey because he's scaled, he's experienced, he's incredibly generous with sharing his knowledge. So I hope you enjoyed the pod today. Look, we're just getting started, so we're super open to feedback. Would love to hear from you. Questions you want answered, types of guests that you'd like to hear from. We've got some exciting investors coming on board, some exciting operators and founders in our next few shows. So let me know, reach out to me, DM, Twitter, LinkedIn, and would love your feedback just to hear what you think. Thanks for joining and look forward to having you on the next one.